Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we're back. Episode 159, Carson's Facts versus Feelings. Sonu, for the YouTube channel, can you show us all your fingers? Did you survive
Yes,
the fireworks?
Yes, it's all,
hey,
all
look at
10,
that.
all 10.
All 10 fingers. So give us the quick summary. You already told me a little bit. You almost had an episode, an issue. How'd the fireworks go?
Oh, it was wild. It was wild. You want to set money on fire. You've heard the term set money on fire. If you want to set money on fire, fireworks is the way to do it.
There you go.
And it was a tussle. My wife was like, "Why are you buying so much?" I was like, "I'm not buying enough." And during the thing, eventually, like, this is for the kids. We're doing a Diwali celebration at home. You have a nice area at the back where there's enough room to do a lot of fireworks without getting busted by the neighbors and Chicago police, and so it's all good. But our kids are like 9-year-old, and their friends are there, and they're lighting these sparklers, and they're like, "Hey, can you point the sparklers away from everyone else's body?" Right? So one kid, touched somebody else, and it was on her sweater, and suddenly the next thing I know, her sleeve is on fire. So I'm like, I just go straight to her, just grab the whole thing with my fingers, right? I just press it, like it went away. There's a big singe. It's like a black armband right now on her sweater. I was like, hey, you know what? Kids have to. I'm in the camp that kids have to figure this stuff out. This is how they get safe. You can't protect them from this stuff. This is how you learn. And hopefully there's an adult to, put the fire out, literally.
Yeah. Well, glad you made it. I remember being a kid, like we played with lawn darts back in the day, like the real lawn darts. You throw them way high in the air, and if they hit you, they were going to leave a real mark. And yeah, I don't think they do those anymore. Those were a little dangerous. Did you have lawn darts growing up Middle East, India back in the day? You know what I'm talking about? Those real sharp ones.
I've seen it. I've never played
they go
with
through
them,
your head if they hit you the right way. I mean, it was... Yeah,
but that was also that for my kids.
That was also the 80s when they had to give that commercial at 10 o'clock. Do you know where your children are right now? They had to remind parents in the 80s they had children, and had to remind them to get their children inside at a certain time.
That's
so
funny.
I think people are a little more helicoptery than they once were when it comes to that.
Yes.
Anyway,
I try not to be
episode 159. Yep.
Yep.
That's good. Hey, that's good. Here comes, or what do we say? Yeah, here comes the year-end rally. So we're calling this in this week's edition of Facts versus Feelings. So let's talk, we didn't really like we usually. We didn't prepare. Go ahead. Yeah.
Yeah. Happy birthday. By the time this episode is released, that will be October 29th. October 29th is when this episode is coming out. So all of you listening will be, Wednesday. October 28th, best day of the year, also happens to be Ryan Detrick's birthday. How about that? You can't make this up. Best day of the year has to be Ryan Detrick's birthday.
You cannot
happy
make
birthday,
it up.
buddy.
Thank you. Yeah, thank you. The literally the best day of the year on average for the S&P 500 since 1950 is October 28th, my birthday.
I have to check the math on that.
Who knows? By the time, so we're recording this, everybody, on the 27th. I made it up. Yeah, don't check it. No, it's true. I think. I don't know. Anyway, whatever. We're doing this October 27th. So who knows? Maybe we'll be down a lot on my birthday. I don't know. But we're having a good rally today on the 27th. Something that I think people know this, but on the Carson team, Sonu, you, myself, there's different members of the team. We manage real money, right? We have something called the Carson House View models, and we don't want to give away the magic of the Carson House View models, but we talk big picture a lot of times on this. We've been overweight equities, as we've been a broken record for 3 years now. But we actually added a little bit of equity risk to those Carson House View models. Last Wednesday, and the market's gone straight up since Wall Street heard rumors that Carson Group was back, going way overweight equities. But
Ryan's giving the secrets away on TV. That's all good. After we trade, it's all good, right?
Yeah, exactly. After we trade, we gave it a couple of days. Now it's out there, so we have gone a little more overweight equities. We think there's a year-end rally coming. Now, Sonu, let's talk about that. We'll talk about inflation and the Fed and some other stuff. Let's just start with the market. I mean, market's rallying. I'll start and then turn to you. I said this before. October's supposed to be scary. October's supposed to be spooky. We knew coming into this month that we had a 5-month rally, that we gone 33 days in a row without so much as a 1% move up or down. We knew we were going to have more volatility. We had it. We came into the month. Everybody told us how bad the government shutdown was going to be. It was going to end the bull market. What else? We had President Trump supposed to meet a couple of Fridays ago, down 2.7% on the S&P 500, freaked everybody out. And then 2 Fridays ago, we had the worries of what we talked about last week. By the way, shout out to Kate. Kate Hall on our team joined us last week, talking about private credit, private equity, regional banks, BDCs, all that stuff that a lot of people don't quite understand what's going on, but it sounds kind of scary. Well, that caused a huge VIX spike 2 weeks ago. Sure enough, the VIX imploded. So those are some of the signals we were looking for to get back in for a potential end-of-year rally. But I think, Sonu, October did its job. It's supposed to shake the tree. It's supposed to scare investors. And then once you scare everybody and get the weak hands out of the way, the end-of-year rally starts. And that's where I think we are. So take it away. What are some things you're looking for that will be a reason we have a strong end-of-year rally in 2025?
I'm a simple guy. So just 2 things, momentum and seasonality. And we'll talk about the Fed and all that. There's icing on the cake, or maybe that's the cake. I mean, maybe momentum's the icing and seasonality is the cherry. Yeah. Right, there you go. Like, that was straight out the top of my head. But one thing, we were talking about the title of this episode before.
Do you like banana cream pie? We've never talked about this. Do you like banana cream pie at all?
I've never had it.
Really? Okay. Yeah, I like that one. I'm a chocolate guy.
Somebody needs to send that to me.
You and I are chocolate. My mom used to make banana cream pie. Nobody can touch your mom's food. My mom, she made banana cream pie. That was always, that was a good one.
Next time I like chocolate, but that was good.
Yeah, maybe maybe try to make some. Although I'd ruin it. I don't know.
Right.
Anyway, go ahead. I don't know where we're going with that. Yeah.
So this year, I feel like we're doing this a little earlier than we normally do, because in 2024, we had an episode 50 episodes ago. The post-election chase is on. Right? 2 years ago, episode 62, we had Welcome to the Year-End Rally. This is the title of this one is, here comes the year-end rally. Hopefully
we don't want to mess with the algorithms. We wanted to keep them separate. So, yeah.
But we've been doing this, and that gets to the idea of seasonality and the fact that this year, I mean, it's hard to say that this year people have been more bearish than 2023, but in some ways, yes, right after what happened in April, Liberation Day, people everything's going to, the economy is going to fall off a cliff, recession, blah, blah, blah. We've had 6 months of continuous gains, right? As long as October doesn't crash now. But, markets are 1% as I speak. So, yeah, we have that going for us. And you've shared the charts. Yeah. People are still fearful. So, yeah, maybe there's a chase coming.
Yeah, we talked a little bit about this last week, but I know the AAII, and so I'll see if I can get it right. American Association Individual Investors. There it is. There's still more bears than bulls in there. Our friends at The Economist, every time I see a cover, it just looks like the world is ending. But then the CNN Fear and Greed Index was close on Friday, hitting new highs, very close to extreme fear. Now it's more in the middle of fear at the time we're doing this. And there are pockets of optimism, sure, but it's just fascinating to me, some of this. Now, David, we could go with the first chart. It's the You Are Here chart we could put up on the YouTube channel. It's just simply, what does the average year look like for the S&P 500? As you see on YouTube, Sonu, you bottom on October 27th. The day we're doing this. And then on
the
28th,
day before Ryan's birthday.
My birthday is you buy the close on the 27th and hold for Ryan's birthday. But then you tend to have a pretty strong rally. Now, layering onto this, I've taken looks at these things. The year after a 20% gain, sure enough, you also tend to have a really strong end-of-year rally. You're going to hear a lot about this. November, December are usually pretty strong. Dave, we can put the other chart up. And the other one is when you're up 15% for the year. Going into the last 2 months, let's be very clear. We don't know because this month isn't over yet. We are right now up there. November and December, both, as you can see on the table on YouTube, do better than the average returns. And the rest of the year, higher 20 out of 21 times. The final 2 months of the year when you're up 15% going into it. And the average return those final 2 months is 4.7%. versus the at any time year up 3.3%. Again, that's when you're up 15% for the year on the S&P going into the last 2 months.
So bottom it's good line, anyway.
Yeah, it's good anyway. So I'll turn it to you, Sonu. Bottom line is things get a little better when you have this. And I think it's that chase. Here, I'll turn it over to you. We talked last week. Let's do it again. Bloomberg had that cool chart. Tom Lee shared it, buddy. Tom Lee over FundStrat, that only 22% of active managers are beating their benchmark. Is there really a chase because people are behind? I mean, I kind of believe that, but what's your take on that?
I think so. I mean, I don't know if there's any particular, like, because everyone's not colluding, at least you would think, hope not. You'd be like, you know what, I'm lagging the benchmark. I need to, I can't be short, right? Going into year end. First of all, the seasonality. And then if you're already lagging the benchmark, you're like, wait, I need to load up on some positions. And which is probably why the next 3 months are positive. I mean, historically, November, December, and into January too, right? Mid-January it's all positive. So there is that aspect. February gets a little choppy. I mean, we'll save the rest of it for, future episodes and our outlook for 2026. But right now, I think, like I said, the chase is on.
Yeah, just one more kind of interesting. I'll admit, small sample size, as I say. If there were more sample sizes, I would share them. When you're up the month of May, June, July, August, September, and October. So that's a 6-month win streak coming into November. Everybody, it's only happened 3 times. All right, let me get it in front of me. 1958, 1980, and 2017. November has been
just 3 times a 6-month
rally
like
that
this?
Because usually sell and may go away, right? I mean, usually you're not up during this. It's all 6 months during the sell and may go away period. That's one way to look at this. When you are, though, November's never been lower, up 2.2%, 10.2%, and 2.8% for a 5.1% average return. Again, only 3. It's skewed by the big 10% rally in 1980. December's higher 2 out of 3 times, but those 2 months combined up 6% on average and median of 6.5%, pretty much double your at any time return. So again, those are 2 ways to look at it. Up 15% for the year going into the last 2 months, up 6 months in a row going into the last 2 months. You're going to hear a lot about how we're extended, we're stretched. I wouldn't disagree, but I think we had that refresh of fear with that VIX spike up near around 30 a couple of Fridays ago. That's what the doctor ordered to kind of shake the tree, get rid of the weak hands, and then keep things going. What else want to talk about for a year-end rally, Sonu? Earnings or something else? What do you want to talk about?
I mean, earnings, positive. Look, we're not, the shutdown is still on, day 27. I think right now markets are pricing, day 27. I think markets are pricing like 45 days or who knows. Hopefully by the first week of November, there's a little more urgency. I don't know if the government will open back up. But anyway, we haven't been getting any macroeconomic data. We got inflation, but we'll set that aside. We'll talk about that.
Yeah.
So no macroeconomic data. So what do you look at? Look at earnings, right? I mean, I'm not listening to every single earnings call and figuring out, okay, what's happening with balance sheets and income flows, things like that.
Right.
But, what's a macro picture? And I think, the big takeaway is things are fine. That's it.
That's a good way to put it. At least as of Friday, according to data from our friends over at FactSet, about 29%, maybe 30% of the S&P had reported. 87% beat on earnings, one of the best numbers we've seen in a long, long time. And like 83 or 82% beat on revenue. Again, one of the best numbers we've seen. Now, here's something I want to bring you in on this. We talked about this a couple of weeks ago, where, I hope I say this right, I always get a little mixed up on this. During the current quarter that you're in, you tend to see the earnings guidance get cut for the next quarter. So what I'm getting at this time, 2-3 months ago, a couple companies maybe lowball it, maybe analysts lowball it. You tend to get revisions a little bit or estimates a little bit lower for that next quarter. What we just saw for this quarter we're announcing now, we saw actual increase. Okay, which is extremely rare. I think it's been like 5 years off of late 21, the last time we saw that. So a long-winded way of saying, I think the bar was actually pretty high coming in its earnings season. It's like, what worries you? Well, the bar's a little high because companies actually increase earnings guidance expected, and they're now trouncing the higher expected earnings, which is, and again, why we're hitting all-time highs. You want to add anything there or talk about something else?
I mean, companies are beating on earnings, but one thing interesting, I saw this from our friend Sam Rowe. So shout out to Sam.
So he's not my friend. No, Sam's my boy. No, I'm just joking. But Sam, Sam says, I sent out the October 28th. That was a good day. He says something like, what about all the October 19th? I'm assuming Sam's birthday is October 19th. Maybe he's picking a random day.
Is October 19th the worst day of the year?
I don't. Oh,
I think
maybe
that's why.
That's why
October
Sam said.
19th.
Well, that was
is
the
worst
crash.
day.
You're right. That was the crash. Yeah, see, Sam's humor is always above my pay grade. Sam thinks way up. That's exactly what you think. I mean, I'm the guy running around citing every stat under the sun about October 19th. You'd think I would have
do that.
You think I would have figured it out? Whatever. Well, but shout out to Sam. Over ticker, we're big fans of Sam. Yeah.
So he tweeted this. This came from Deutsche Bank. So he wrote that sales beats. So U.S. corporates or companies are showing the highest sales beat ratio in 4 years at 69%. So that's higher than normal. And what's interesting is these have correlated well with inflation surprises, because usually what happens if inflation's going up, sales revenues are going up as well because companies are passing the stuff down to consumers, right? Which means they're beating on sales and revenue. The good news is they're beating up profits, and profit margins also going up. So yeah, it was just interesting to me that it correlates strongly with inflation surprises. And of course, we have some inflation right now. We're going to talk about it, like 3% being the new 2%, right? 3% inflation, everyone's kind of getting used to it. But that's not a bad environment for companies. Right? No. They push the prices out to consumers. They're able to boost margins. And it's I've been in the camp that as we go into 2026, we'll see a period of inflationary growth. Which I think is very good for stocks.
Yeah, no, well said. You've said that a couple times lately. We'll get more into that. Just from a market's point of view, we have various advanced decline lines. It's a cumulative basis, how many stocks going up versus down, hitting all-time highs, specifically the S&P 500 advanced decline line just last week. And who knows, maybe the time we're doing this, doing it again. And a lot of people say, the market's not broad enough. There's only a couple stocks going up. We've pushed back against that.
Are they still saying that?
Yeah, we're still hearing it. And shockingly, but that's one easy way for me to say, no, that's not the case at all. Because yes, the advanced decline line on the S&P 500 and NYSE peaked in late 98. That went down for like over 2 years, but stocks kept going up. Now, what stocks were going up? It was like technology stocks, right? The internet bubble stocks were really leading, but the only thing going up. So it was a weak underpinning. We're not seeing that at all. So one thing we've also just seen, if you look at the S&P 500, sure, there's a lot of NVIDIA in there. There's a lot of Microsoft in there, a lot of Apple. There's something called the equal weight. Like the name would suggest, all those stocks in there count the same. Well, the S&P 500 equal weight, the Dow equal weight, and the NASDAQ equal weight just last week, are you ready for this, hit all-time highs together in unison. We've got small caps breaking out. We've got mid caps. They do highs yet? I don't think they have.
Have they? Think so.
Yeah, but they're doing all right. They're they're lagging, but nonetheless, as we said on here, we kind of like the large caps a little more. But nonetheless, it's just enough more signs to me that this market's healthy and alive and well. One more thing, I'll turn it over to you. We already talked about it, but it's important to note the bull market just turned 3. You go back 50 years. Oh yeah. No bull market didn't make it to its 4th birthday the last 50 years. The average was 8.
We are in the 4th year of the bull market.
We're in the 4th year. And again, going back 50 years, there's been 5 of them that made it this far. None of them ended during the 4th year. Okay. The average was 8. 2 ended at 5, 1 at 14, 1 around 11. So, hey, these are just things to think about as we are formulating, again, our big picture macro views and investment views for 2026. We're still pretty optimistic, if you can tell. We're not sure how optimistic yet. We're thinking about it. But these are things that we're swirling around. What else is out there? I mean, the Fed is kind of like next step to this. Inflation is next step. Anything purely on the stock market point of view as we kind of dive into inflation and the Fed?
Actually, I mean, stock market adjacent, gold, right? Gold pull back. I mean, are you worried about that? Or, I mean, it was going to, too fast, too soon.
Well, I mean, I would say I'm not worried. I mean, you and I, we have gold in our models. Right? We've talked about this before. Yeah. And we said it's one of the first times, at least the 3 years you and I have been managing money together, we actually would be okay with one of our positions going against us. We're like, because if gold just keeps going, it's like, I don't know if I really like that so much. So no, I think it's just simply time. Jeff DeGraff of RenMac, Jeff was all over back in April, why it was extended, why it was likely time for consolidation. We actually kind of talked about that in this very podcast. And then we had a 3 or 4 month consolidation in our longer term strategic models, maybe September-ish. Sonu, when did we do that trade?
July.
We added some, again, for 3 to 5 years in gold after it burned off is a good way to put it. Those excesses. Well, Jeff just today or yesterday was talking about the same thing. He says, in some ways, we're more overbought now than we're in April. So it's probably time for it to burn off. But just remember, things can correct 2 ways. Through price and time, or through price or time. And what happened again in the summer months, gold just went sideways. I mean, I forget the exact level, but gold went sideways for months, working off that overbought scenario. Not like it pulled back 20% or something. It did not. Maybe this time could be different. I don't know. But the reality is I think gold is due for a little bit of a pause. That's okay. I think that'd be perfectly healthy. 2-3 years from now, yeah, I still think gold's going to be up. Maybe even a good deal. Once these objects get moving, they keep moving. But I still think stocks are still the place to be. What else about gold do you want to talk about?
I have an anecdote for you. This came out from a paper that I just saw. Shout out to my friend Lawrence Hamto, who's in Kansas, I believe. But you know the guy Cam Harvey in Duke? I think he came up with the yield curve or something like yield curve inversion. He's done a lot of work around that.
He is the yield curve inversion. Yeah.
Yeah. So he wrote a new paper on gold, and he's writing that gold has held its value over 2,500 years, and its purchasing power has not changed. So here's an example from Roman military payrolls. The annual salary of a Roman centurion in the army in the reign of Augustus was about 39 ounces of gold. Based on gold's average price over the past year, that's what a U.S. Army captain, major or lieutenant colonel earns today. How about that?
Wow.
Yeah, the gold does not change its value.
Well, that's why I should always own a little bit of it. Hearing something like that.
Anyway, I just wanted to throw it in.
Yeah. No, it's interesting.
Whether it's relevant or not, but yeah.
Yeah, that's interesting. I heard Augustus. My son's name is Gus, and no, it doesn't stand for Augustus or Augie.
I was going to ask, does that sound
simply Gus? It's just because we went first. My daughter was first, right? We came up with Susanna. Well, no one could spell Susanna because there's 19 ways to spell it. And then we came up with Sebastian for my second kid. No one could spell Sebastian because it's confusing. By the third kid, we just said Gus. Everybody can spell Gus, including his mom and dad, or maybe his dad. So it's just a little bit easier to go with that.
It's not short for anything, I guess.
Oh, he's just a Gus. I don't know. That's on a birth certificate. Gus Henry. There you go. That's him.
There you go. Yeah. I like the simple ones. My son's name is Sam. So easy enough.
That's true. Your dad's name was Sam, right?
My dad's name is Sam. My grandfather's name is Samuel. I joke that our family has no originality when it comes to names. So.
Well, there you go. Before we go into inflation and the Fed, Sonu, something kind of was all over the place, and I don't have a real strong opinion on it, but it took social media by storm over the weekend. It was the take that someone paid off their mortgage early. Now, they had a 2.6% ballpark mortgage, and everybody had an opinion on this. A lot of people, financial people like our world, said, why would you do that? You can just go make 4% somewhere else. Yeah. A lot of other people said there's nothing like not being connected to the man, owning your house and not having to worry about it. I see both sides. I don't have any dog in this hunt because I still have a mortgage and I haven't paid it off. What's your take on that? Because it feels like, I don't know. Well, we'll leave the witness. What do you think?
I don't know. Like the math part of it is just says, when I have a mortgage with a rate that's really low.
Yes.
I'm not paying it off.
Yeah.
I'm going to stick it. Like, are you kidding? Give me a loan at 3% or 2.5% for 30 years. Are you out of your mind? Well, I guess the U.S. government is out of their mind, so I'll take it, right? So they've subsidized my house to a really large degree here. But yeah, but I get when people say, you know what, I don't want to have any debt. And I think growing up where I did, my parents would have been in that camp and they built a home that they wanted to retire in. It was cash. Nothing. You're not taking on any debt, right?
There you go.
So I get that.
Yeah. Well, I mean, I had a lot of different people reply to that on X when I sent that out, and some financial advisors I think very highly of. And they actually said, listen, you can tell me all you want about time value of money, and you can get 2% versus 4. He's like, my happiest clients are the ones that pay their homes off early. He's like, they have no debt. They are by far the happiest ones because they know they don't owe anything. And all these people, for the most part, have made a lot of money in real estate and the stock market and just working the last several decades. So anyway, I don't know. There's no right or wrong answer. Kind of depends on the person. But that was all over social media, and by the book would say you should never do that. But sometimes the book doesn't always come in, and sometimes people just like to say, I own my house outright and I don't have to worry about it anymore. So, all right, let's finish things up with inflation and the Fed. I guess start with inflation probably, then go to the Fed. That makes more sense, right?
Yeah. I think speaking of, like that's another piece of this, right? You inflate your debt.
Oh, there you go. There you go.
That's another added reason, but I get it. That's the math part of it, right? But the behavioral part, maybe like, I don't want to be, en hoc to someone.
Yep.
Anyway, inflation. Yeah, we finally got some macroeconomic data. How about that? And it looks like this will be the last piece of, forget, any macroeconomic data. I don't think we'll get a October CPI report. So the next report, assuming the government opens at some point in our lifetimes, but hopefully within the next 2 weeks.
Our lifetimes. So why did we get it? Why did they make everybody come back to work and figure out that number? What was the reason?
No, I don't think they're getting paid actually for what all the work they did. But no, they had to calculate cost of living adjustments for Social Security.
Got it.
That's why,
okay.
Right?
Okay.
I originally thought it was because you have these Treasury inflation protected securities, right? And that's based off CPI. I was like, oh, maybe that's why they're coming back. But when I dug into it, I was like, oh no, Treasury can make an interpolation or extrapolation based on previous month's inflation data. And that takes care of TIPS, right? Treasury inflation protected securities. But for COLA, which is cost of living adjustments for Social Security, you need the number and seniors vote, right? So you don't want to tell seniors, 0% increase in
Turns out they do.
But anyway, we got the CPI numbers September. Look, expectations were running on the harder side and things came out as not so hot. So that's positive. But inflation, you look at inflation, it's pretty hot, right? It's definitely much further away from the Fed's 2% target. Headline CPI in September is up 0.31%. What does that mean when you translate that to an annual pace? 3.8%. 3.8%, let's all agree, it's pretty hot, right?
Mm-hmm. Yep.
Last 3 months, headline CPI, headline consumer price index, running at 3.6% annualized pace. Last 12 months, 3%. Core CPI, and David, we can put this chart up. Inflation remains stubbornly elevated.
Okay.
Core CPI, and this was the good news, right? Expectations were for 0.4% increase last month in September. Core CPI came up at 0.23%. Again, what does that mean? Annualized pace, 2.8%. So 2.8%. I mean, it's not 2%, right? It's still elevated, but it was not as bad as expected. Last 3 months, 3.6%. 12 months, 3%. We've been up at or above 2.8% with core CPI for 4.5 years now, since March of 2021. The Fed, in their dot plot, in their projections, they don't expect CPI, or well, technically PCE anyway, they don't expect inflation to go back to 2% before 2028. Think of that. For 7 years, inflation would be running well above their target. Right?
And how'd the stock market do?
Yeah,
I mean,
there you go.
Yeah.
But I think, 3% is a new 2%, but that's not all. The Fed is cutting rates on top of that. We'll talk about that, right? Markets expect rates to head to below 3% by next year. I think that's very dovish. I think that's very bullish also for the stock market.
Well, no, great points there. When you talk about the inflation data, you've been all over this. You and I did a call with our Carson partners just this morning where we dove into a lot of these things. And you pointed out some of the acceleration areas like apparel. Apparel's up 0.7% month over month from up 0.5 the month before. Yeah. Home furnishings, 0.2 from 0.1. Medical care services, 0.3 from 0.1. And there's a lot more. But again, you think apparel, you think home furnishings. Those are things that are impacted potentially by tariffs. Is it that simple? That's kind of where we're still seeing it from the tariffs? Yeah.
So there is, you think about inflation or CPI, the three big pieces to it. I would set aside food and energy. Let's talk about core CPI. You got housing, which is about 42% of the basket. Okay. Then you got core goods, 24% of the basket, and then core services, 34%, about a third of the basket, right?
Does that add up to 100? I lost track. It should. Close enough. It should. Whatever. If it doesn't, let us know. Actually, we have comments. Let Sonu know in the comments on the YouTube channel what those three numbers he just said did not add up to 100, but I think it did. I was trying to pay attention.
42 plus 24 plus 34. I think that adds up to 100.
Close enough for God to work. Whatever. Yeah.
So anyway, let's start with shelter because I think we could just, we've been talking about shelter for few years now. Ever since we started this podcast, we've been waiting for shelter to get into like disinflation, not quite deflation, but disinflation. That means, the rate of change of prices start to go down. And we're seeing that. Rents went down 2.4% annualized in September. Owner's equivalent rent, the rent someone like me as a homeowner pays to myself, presumably, that was up only 1.6% annualized in September. Wow. That was really low, right? So, and look, the good news is there's more disinflation to come. David, we could put that chart up of shelter disinflation happening. Look, you look at market rents, whether it's Zillow or Apartment List, right? Rents are down for Apartment List 0.8% year over year in September. That is the 28th straight month of declines.
Wow.
Official data is probably capturing what happened real time 2 years ago or 1.5 years ago. So, which means 1.5 years from now, we'll probably still see shelter and disinflation.
Oh,
I'm laughing as I say this, but anyway, it is
what
quite
did
ridiculous.
Yogi Berra? It's deja vu all over again. I mean, you and I have been talking about this very concept. That chart we just shared on YouTube channel is one of my favorite charts you came up with. You said, listen, inflation's higher than anybody wants. Yes, we just had 9% inflation, 22. We get it. But it was saying likely there was going to be some disinflationary pressures out there. Inflation overall is going to come back. And I think that's one of the big reasons why there's more. I get it. But one of the big reasons we've rallied so much these last couple of years because inflation has come back so much, and the chart you just shared with the what's going on in shelter is likely there. So we think shelter for years potentially could be a kind of a cap on inflation. Is that the way to put it?
I think so. Safe to say,
okay.
Right?
Okay.
Which means, look, shelter makes up 42% of core CPI. That's a big deal, right? That means, but then you think, oh, wait a minute, why is inflation still at 3%?
Right.
Yeah. That's basically everything else is running hot, and that gets to what you were talking about, apparel and stuff like that. That's tariffs, right? You look at core goods, it's about, like I said, about 20, a quarter of the CPI basket.
Okay.
Now, I don't think the tariff impact has been as bad as expected for two reasons. One is I think companies are still eating a chunk of the cost, not entirely, they're passing some of it down. That's why we're seeing sales prices go up. But a lot of the tariffs, Ryan, have been rolled back. Less than 50% of imports are being tariffed right now, more than they were in January, right? Like comparing, where things were in January before the administration came in to where things are now. It's pretty much the best case scenario. Look, a lot of electronics from China, even computer parts, things like that are not being tariffed, right? iPhones. But you look at core goods inflation, and David, we can put this chart up. Core goods prices are rising on the back of tariffs. Last 3 months, it's running just under 3% annualized. This year to date, it's running 1.8% annualized. And you think those numbers don't sound bad. But the thing is, goods prices historically for the last 25, 30 years, they've been going down, except for COVID when you had the supply chain crisis. Other than that, from like mid-90s to 2020, goods prices just going down. So we had deflation there. Now we're going the other way. So that makes a difference, right? But it's basically all the stuff you mentioned. You look at price changes from April through September, 6 months. Furniture and bedding, it's up close to 7% annualized. Vehicle parts, equipment, also about 7%. Toys, Ryan, 5.5%. Recreational commodities, sporting goods, TVs, audio products, about just under 5%, right? So now you can argue that this is transitory. The Fed is not going to use that word. I will. But, there's, I think, a good case to be made that, this stuff will go away. By next year, hopefully, we won't see this kind of inflation in core goods. But I think the outlook is messy. That's partly, and we'll talk about core services. But go ahead.
So some real examples of real world. Sometimes we talk about this stuff, and we get it. There's real world things here because both of my boys have birthdays in September, October. Football season's ending. Basketball season's on the way. I usually buy them both 2 new basketballs for the season to use. Right, buy them 2 because we go to the gym and they shoot 1. I get the rebound, shoot another, shoot faster. Anyway. So I ordered 2 for Sebastian and 2 for Gus, just literally in the last week or so. And it's like the exact same 2 I bought the year before.
Okay.
And I looked, and like the ones for Gus, I'm going to go approximate here, like $74. Now they're $85. And one for Sebastian, like 81. Now they're like 95. So that's sporting goods.
That's a lot of inflation there.
Dude, you're not kidding. I was like, what in the world's going on here? They better be really good because I'm wasting money if not. Anyway. But yeah.
That's like a 15% raise, increase. Like you need to ask for a 15% raise. No,
I'll tell you, maybe. Just so I can play,
if the folks upstairs are listening here.
So I can pay for these basketballs I'm buying my kids. Exactly. But that's the real world stuff. You just mentioned sporting goods and those, hey, it's basketball season. Maybe, you know what though? Oh my goodness. Who's the... Jeez, the old school fundamental guy who taught Warren Buffett. What was his name?
Graham.
Graham said, "Buy your straw hats in the winter." I'm literally buying basketballs literally when basketball season starts. So maybe, just maybe, I should be listening to what Graham says and be buying.
But you're not a fundamental guy.
I'm not. I'm a momentum. A momentum sentiment guy. Like, oh, wait a minute, it's a birthday. They need because once your kids get to a certain age, Emily, my wife's like, what are we gonna get them? So I'll just buy them basketballs. They can get basketballs. Which, by the way, you want to talk about burning money, Sonu? I'm going on a rant for a minute. I spent like $1,000 to go see the Bengals. Okay, for my whole family to go. Decent seats, whatever. They were beating the New York Jets. The Jets are 0-7. The Jets, literally their whole team was hurt. They're terrible. But you see where this is going. They hadn't scored an offensive touchdown in 2 weeks in a row. The Bengals are beating them pretty good. Bengals are up 15 to start the fourth quarter. The Bengals allowed 23 points by the Jets in the fourth quarter to lose 39-38. You want to talk about setting money on fire? I literally should take $1,000 and just ripped it up and put it on fire, because I would have enjoyed that way more than that frustration.
Hey, you can
Mike Brown and his family has given the fine city of Cincinnati once again to lose to the worst team in football. And honestly, maybe we're the worst team now. We deserve to be. With a defense like that, we deserve to be the worst team. Anyway, just had to get that off my chest. What else are we talking about?
Connected to that, what else? Where else prices are going up for all services like movie theaters, sporting events, concerts? Inflation's over the last year, it's up about 4%, more than 4%.
Bengals tickets are cheaper now, I guarantee you. They're doing a great job. Nobody wants to go to the games after yesterday. Nobody wants to pay for that stuff.
Between the Bengals and the Jets, maybe they'll solve our inflation problem.
I've never cussed. I was like, no one's pay for that blank. You just imagine the word I want to use, because I've never cussed on our podcast. But yeah, that's what it sure felt like. Yeah.
But look, like I said, shelter is going through disinflation. The problem is core goods are running hard, which would be okay. Okay, that's transitory. Problem is core services, about a third of the CPI basket, core CPI basket. That's also running hard. Last 3 months, it's running about 4.7% annualized pace, right? Last 12 months, year over year, 3.3%. What does that mean compared to what's normal? 2017 to 2019, core service inflation is 2.2%. Now, here's the thing. You'd expect core services to be hot if the labor market was running hot, but everyone's telling us, and some of the payroll data is showing that labor market's weak, right? So like, wait a minute, if the labor market is weak, why is this stuff running hot? My sense is that maybe the labor market is not as weak as everyone thinks it is, right? Maybe it's not as bad as people are still spending. Otherwise, prices wouldn't be going up. Gardening and lawn care, Ryan, over the last year, 14% year over year. Personal care services like haircuts, 4.6% year over year. Laundry and dry cleaning, 4.9%. Club memberships like sporting fees, shopping clubs. I don't know who's part of a shopping club these days, but maybe there is a shopping club. But 6.2%.
Well, is that just Costco? Is that what that means? Is that like a Costco membership?
Yeah, maybe it's a Costco or Sam's or something. That's true. Yeah, Costco, good point. Yeah. Dental services, 3.2%. Daycare, preschool, 5.2%. So all of this stuff is running
big numbers.
Hot. Yeah. This is, and this is part of what everyone, maybe discretionary spending. Now, pet service is also running hot, 6.9%. As a pet services, you have pet, I don't. I imagine that's not discretionary. You'll do what it takes to get your pet, okay, and all of that. But that's a problem. I think the Fed has a problem because all of this stuff is running hard. You can say, okay, core goods inflation is transitory, but why are core services running hot, right? I think that's an issue. That's basically why we are at 3% inflation.
So the bottom line, I guess, is 3%. So new 2%. We were told for a long time that Fed's target was 2%. Haven't been anywhere. Would you say 48 months in a row, or how many months was it?
54 months. 54 months. 2.8% or higher for core CPI.
Wow.
54 months.
2.8 or higher. Gee whiz, that's a lot. Okay.
Yeah.
All right. Well, so that's that. You want to take it the next step and talk about the Fed, I guess?
I guess, look, the Fed's going to cut in the face of this. Why? Because, they're worried about the labor market. And the Fed's not pushing back against, there's a lot of rate cuts being priced in. Markets expecting one rate cut in October, which will be the day this podcast comes out. The Fed's going to cut, right? October 29th.
Yep.
And they expected to cut again in December. And then the market's expecting 3 more cuts in 2026. Which would take the Fed funds rate below 3%. That's a big deal because 3% is what the Fed thinks is quote unquote neutral. Okay. It's not too tight. It's not too accommodative. So, but at the same time, inflation's running at 3%, which is why this is, that's very dovish policy. The Fed could push back against this, but nobody is doing that. Maybe Trump gets this person and we get all these rate cuts. Everything's going to materialize. But right now, I think, the Fed's dovish, and that's, I think, bullish for the market on top of momentum, on top of seasonality. There's less uncertainty. Earnings, less uncertainty about tariffs. And then in 2026, people are going to get a whole bunch of tax refunds for things like, higher deductions for tips, higher deductions for seniors, more deduction, a much bigger deduction for state and local income taxes, property taxes. That's going up from 10,000 to 40,000. So people, and all this is retroactive to 2025, which means when people file their taxes in February and March, they're going to get bigger refunds. Where do you think all that money goes, right? So I just see a lot of tailwinds, Ryan. I don't know about you, but
well, I agree. No, obviously, we're still overweight equities, and I don't see too many reasons to change that opinion. You mentioned trade. President Trump had what they're calling side deals with Australia, Malaysia, Thailand, and Cambodia on
rare earths.
Rare earths. Sorry, yeah, we talked a lot about rare earths over the last week or two with China. So that's market seemed to like that. Then also over the weekend, Scott Bessent said the quote unquote framework for a deal is in play with China. President Trump and President Xi are meeting this Thursday. Honestly, I don't know what time Thursday because it's the other side of the world, but sometime Thursday, there's by Halloween, we'll know. Maybe they don't sign the deal, but they're at least meeting. What's your feeling on trade with some of these things I just mentioned?
I think, look, both sides apparently reached what they call "quote unquote" basic consensus, right? Okay. I think that basically means
that sounds anything but basic. You know,
I think they agreed not to, escalate things further.
Right. Not have another Friday like we did a few weeks ago.
And essentially what that means is both sides have escalated. Trump said, "Oh, I'm putting 100% tariffs." China's saying we're going to suspend. We're going to put all these rare earth controls, not buy. Well, they already haven't been buying soybeans. By the way, did you know that Scott Bessent is a soybean farmer? I didn't know that.
Wow.
He said that on TV. Like, I'm a soybean farmer too. So I guess maybe he owns a bunch of soybean farms or something. I'm sure he owns farms, but
I'm a I don't even know what to say. We have a Fed president who's soybean farmer.
Treasury secretary who's a soybean farmer.
Treasury secretary. Apologies. Getting all mixed up. Maybe he's an ex-Fed. Maybe that's a Freudian slip. Maybe he's an ex-Fed chairperson. Wow, that's interesting. Okay.
So anyway, I think what they agreed to is the U.S. won't put 100% tariffs, but China's agreeing to suspend its rare earth controls for a year. They're going to do a review. Right? Good. They can put it back anytime, right? Just like the US can put 100% tariffs, 150% tariffs anytime. They're going to buy more soybeans, which presumably good thing for Scott Bessent. So, and they're going to do more to limit fentanyl. I have no idea what that means. What that means in the sense, I don't know what China's going to do. I don't think anybody knows. But anyway, all of this means we go back to that pre-escalation status quo. We'll see how much of soybeans they buy. And with soybeans especially, I'm like, part of me, is this a good thing for U.S. farmers to be reliant on China? China may be happy to start purchasing soybeans again, but that means they have a hostage.
Right, they've got their deal on the other side.
Yeah, they have a hostage if the truce breaks again, right? So it's like, we'll buy $20 billion of soybeans that we're buying from Brazil now, but now you owe us, right? I mean, you're dependent on us to buy these soybeans. Next time there's a kerfuffle, they're like, we're stopping purchases, right? What's China getting in return? Nobody knows yet, but, of course, they're not getting the 100% tariffs. But the question is, are they getting a reduction in the fentanyl tariffs? So fentanyl tariffs are about 20%. That was imposed back in March. There was an increase in port fees for Chinese ships. I think that may be going away. A big thing I think the Chinese want is for the U.S. not to take something called Section 232 tariff actions, which is tariffs on the basis of national security. Those are the ones that will stick if it does come into place. I don't think China wants that. But if they do get that from the U.S., I think that's a major concession, right? So we'll see what happens with rare earths. I think, look, the U.S. wants to sort of near shore or friend shore or reshore rare earth manufacturing because China controls all the production. The problem is because China controls all the production, they control prices as well. As soon as today is a good example. Today we are recording on Monday, October 27th. As soon as news of the deal came out, you looked at rare earth share prices, rare earth company share prices tanked more than 10% down. Right? Yeah. Why is that? Because, prices came down, right? And a few years ago, I think it was 2021, the Biden administration tried to restart, there's an Australian rare earth mining company that's planning to set up shop in Texas, start a new mining factory, processing, refining thing. And what did China do? In 2022, they increased the production of rare earths. Prices went down, and this factory never got built. right? And so I think what needs to happen is the US just needs to subsidize this to a massive degree. If they are serious, if we are serious of bringing rare earth production, refining, processing, all of that back to the US. But we'll see. Right now, China has a lot of leverage on that side.
Very interesting. One other thing we've talked a lot about, at least I have, with the S&P 500, you indeed can cut interest rates with the S&P 500 near all-time highs.
There you go. Yeah.
They did it in September. They're likely going to do it again in a couple of days. This will be a massive sell-off. Sonu, I found the last 21 times the Fed cut interest rates with the S&P 500 within 2% of an all-time high. That's the close the day before. So that would be Tuesday's close in this particular instance, because they're going to cut likely on Wednesday. 21 times that's happened. 1 year later, higher, drum roll please, 21 times, up like 14, 15% average. There's old saying, don't fight the Fed. I don't know. You've got a dovish Fed, like you said here. You've got earnings strong. Every time we have a little bit of a pullback, everybody who says they're bullish all of a sudden freaks out and washes their weak hands and sells, which is actually a good sign. You want that for markets to continue. There's a lot of other things that are taking place that have us pretty optimistic. Now, you said, I zoned out a little bit there. Rule 232, what was that about China?
Section 232 tariffs. Okay. These are tariffs that the U.S. government can impose based on national security concerns. They can say, you know what, we are putting tariffs on rare earths from China. They wouldn't do that because otherwise nobody get rare earths. But let's say they could and do that on the basis of, it's a national security thing. Mm-hmm. We don't want, stuff being exports and imports, right? It works both ways. But that's what China doesn't want. They don't want these Section 232 tariffs imposed on their goods. And so, or anything they need for their production, like advanced electronics, chips, stuff like that from the US, right? For example, the US could say, you know what, NVIDIA, we have these Section 232 tariffs on your chips, so you can't send those to China. That would be an example of it. We don't know yet. Early days, who knows what just keep watching the news, right?
No, well, there you go. Yeah, I heard that and I thought of 237 because it is Halloween season, so I like scary movies. I watched The Shining, not too long ago. So room 237 is the scary room in the. And there's a theory. And listen, it's just a theory. That Stanley Kubrick was involved in faking the moon landing. Again, don't shoot the messenger here. It's kind of fun to do. But the moon is 237,000 miles away from the sun. And there's all these other little subtle things that he put in this movie. I'm not saying it's true. I'm just saying it's interesting. It's a pretty cool movie. Also, I saw, I watched The Substance, which just came out on HBO Max. It's the one with Demi Moore. It's like a horror kind of movie, and I read the preview, or the people said it's bonkers, and I'll tell you, if anyone has seen what I'm talking about, the third act of this one, absolutely bonkers and the craziest thing I've ever seen. And I also watched Weapons, kind of a new one just came out, also.
Is that
a horror movie
too?
Yeah, it is, although it wasn't really scary. It was more psychological. I didn't like it that much, but I know it was pretty popular. So again, it's Halloween season, and Trick or Treat, I love that. I watch that every year. It's like 2000. This is 15 years old. That's a great one. So just some I like some scary movies, but you don't really like them, right? You just don't even enjoy scary movies. But terrified doesn't mean you like it, I mean, no.
I just, I'm just too scared to watch. I wimp out. And the last one I saw was The Ring, and we've talked about that before.
That was a long time ago.
I swear I haven't seen anything since that. So
which
I like thrillers and stuff like that. But,
I don't know. I like that stuff. I don't know. My mom was demented. We watched a lot of scary movies, and I was probably way too young, so I always enjoy that stuff. Anyway, what was I going to say? Oh, Halloween. So Halloween's coming up. We have a special live stream coming up. So if you listen to this podcast, you'd probably be very interested to know this coming Friday, Halloween morning, or late morning. I guess 10:30 Central
Time, 11:30 Eastern Time.
We have Warren Pies joining us, old friend of this program. He's been on this show before. Warren's awesome, and then Joe Fahmy, who I'm a big fan of Joe as well. Both of them. I forget the order. Do you know the order? Not that it really
Joe
matters.
is first, and then Warren.
Okay. So both about 45 minutes. It's a live stream. Maybe we can add the link to the show notes. In fact, David, let's make sure we do that. We can add the link to the show notes to this. But also, if you follow Sonu or I on social media, we've been promoting that a lot. But that'll be a fun live stream. Yes, there will be costumes. I've got one kind of right over there.
And it'll be live on YouTube. So come, leave a comment. And speaking of, if you want to hear the latest from us, don't forget to subscribe to our podcast. Yeah. You can also leave a review. We love your feedback.
There we go. Very well said. Yeah. So I my stuff showed up yesterday. I don't even know what I am. It's just a bunch of stuff, but it's gonna be funny. I think it's gonna be funny. I don't know.
I have something funny.
You know what? Skelly's not behind you. We were supposed to put Skelly behind you.
Oh, I was gonna. You know what? He's sitting outside.
We'll have him on Friday. So that's his skeleton that was behind you a good chunk of last October.
Couple of years. Yeah.
And Skelly. I mean, such a creative name for a skeleton. You know, I mean, it's just so creative.
Actually, before how much time do we have?
Whatever you want. We probably need to wrap it up soon.
Yeah, no, I just want to give a shout out to Nelly, our founder. Omani Carson's dog, Nelly, just passed. Yep. So, Omani, our thoughts are with you. And, my most vivid memory of Nelly is Omani's interviewing George W. Bush on stage. There's a couple I think you were there too, right?
No, this was before me.
Oh, this was before you. Okay.
This is before my time.
Yeah, and Nelly just walks up on stage, right? He's sitting right next to Bush. And, it was a great memory. But anyway, thoughts are with you.
Yeah, no, definitely. And we obviously, Nelly's is the bar.
Yes.
Social area at the home office in Omaha. And you and I filmed a video on our YouTube channel just last month or so when we were there for live from Nelly's. So definitely thinking of you, Omani and family. And Nelly was a special dog, but so much more than a dog. But all of us have, not all of us, a lot of us have animals that are like, well, that's more than a dog. Like, you can't just call that's like family. And I get it totally. I mean, Walter's not down there, but he's my 145-pound Great Pyrenees, who I joke has been on TV more than anybody you know, because literally he's snoring like right next to me. I'll be on TV tomorrow, like 6 in the morning. We don't know because we got him as a rescue. We're assuming 7 or 8. He's kind of slowing down. He's a big dog. Okay. He's kind of overweight. Yes. I mean, it's kind of hard for him to actually come down the stairs. So he's not even coming down the stairs. I can't lift him to bring him down the stairs.
Wow.
So anyway, but we get it. Dogs are very, very special things. So, all right. Anything else you want to talk about, Sonu, before we wrap up this week's podcast?
No, I'd say don't fight the Fed, don't fight momentum, don't fight seasonality. And a lot of tailwinds.
Well said. I think you summed it up really well. Yeah, again, definitely check out the live stream that we're going to be doing this coming Friday on Halloween with Joe Fahmy and with Warren Pies. That should be awesome. And with all of that, everyone, enjoy the week. Enjoy Halloween. If you shoot off some fireworks at Halloween, just be like Sonu was and come back with all 10 fingers. Yes. Very important. And
don't burn the kids.
Don't burn the kids. Don't do any of that stuff. Just enjoy yourselves. And I guess, let's see here. Yeah, we'll see everyone in November. It's kind of weird to say, isn't it? Like the next one of these is November. Then again, we just spent the whole time talking about November, December being strong, but it's like it's hitting me now when I looked at the calendar. It's like, oh, that is really happening. All right, everyone, enjoy the fall. Get some pumpkin pie too. That's a good one. You like pumpkin pie, Sonu?
Oh, y'all love it. Love it.
Yeah, it's time. So whipped cream. Oh boy, we're getting hungry just talking about all this stuff. All right, everybody. See you next week, or see you Friday. See you Friday. Take care, everyone. Thank you. Goodbye.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.